Good afternoon and welcome to the ACT webinar sponsored by Standard & Poor's Global on the latest trends in the funding markets and what they may mean to treasurers. I'm Sarah Boyce and I work in the policy and technical team here at the ACT. Firstly, before we get into the webinar itself, a few technical points about the webinar set up for those of you who have not joined us before. There is a menu bar across the bottom of the screen that allows you to open various windows, and you can move these around your screen, resize them or minimize them. The yellow button with a question mark is there for help if you have any technical difficulties. The Q&A button opens a window where you can submit questions, which we will take anonymously. And please just send questions in as they occur to you, and we'll pick them up as we go along, as the format of this webinar is very conversational and possibly really going to be quite informal. We do have a small number of slides that we'll put up during the webinar, really just to help us keep on track. If any of them are hard to read, you can maximise the window that they're in. A recording of this webinar will be available on the ACT website in a couple of days' time. So let's get to today's topic, funding, taking the funding pulse. Today I'm in conversation with Neil Garrard, who is Global Treasury Director from Vodafone. He is responsible for funding the vast majority of the group's 19 global operating subsidiaries and for managing all of the financial risks the group faces. So that's Monday to Thursday, I guess. Neil has also been heavily involved with the group's M&A activity, in particular establishing the valuation framework and policy which the group uses for acquisitions and disposals. Prior to joining Vodafone, almost 15 years ago, Neil has worked for a number of investment banks, including Goldman Sachs and Lehman Brothers, primarily trading fixed income. With us as well is Paul Waters, who is Head of Corporate Research for Europe at S&P Global. He represents the corporate group there on S&P Global Ratings Credit Conditions Committee and is a global coordinator in the Portfolio Analytics team. He is responsible for European Leveraged Finance Default Studies and the joint author of S&P Global Ratings Quarterly European Corporate Credit Outlook. Previously, he spent almost 15 years working in debt capital markets in various senior trading and research roles on the sell side primarily. So we're going to spend the next 40 minutes or so discussing the current conditions in the various funding markets that are available to corporate treasurers and the factors that impact the availability of and access to those different markets. I expect that this is going to be, in fact I'm sure this is going to be a pretty wide-ranging conversation, so keep us vaguely on track. Paul has kindly prepared a number of slides. So Paul, before we look at the various sorts of funding that's available, perhaps we could take a few minutes just to talk about why companies fund. So, as it seems to me that the macroeconomic conditions that we're facing may be driving changes in behaviour there. But first of all, can we just talk briefly and hopefully park the elephant in the room that is Brexit? Is it possible to summarise what impact that referendum vote has actually had on the market?
Yeah, no, Sarah, thank you very much. I mean, I think, just to sort of frame this discussion, I think it's obviously sensible just to sort of touch base with what's happened in the last 3 months since the Brexit vote on the 23rd of June. And clearly, what has been a big shock, there's no doubt about that. And it was accompanied by a lot of volatility in the markets at the time. And clearly, going forward, there remains a lot of uncertainty about how this will all play out, but obviously for the UK, but it's not just limited to the UK, it also has sort of European implications as well. But the reality is that not a lot in substance has really changed, but that doesn't mean that the market pricing hasn't actually moved in various markets to reflect the new reality. So on this slide, you can just see, obviously, sterling's borne the brunt of the surprise and the shock, if you like. So sterling is down at more than 10% against the euro and the dollar. So that's actually for the year to date, that's almost 20% down against the euro. And if you look at the equity market, it's very interesting that the UK equity markets, took a hit, very quickly. But obviously the FTSE 100, which is obviously made up of multinational companies with earnings, much of their earnings contribution coming from overseas, actually rebounded pretty quickly. The more domestic market, the FTSE 250, actually took a bigger hit. It was down about 10% initially, and it's taken longer to recover, but it has recovered. I think the interesting thing about this slide, if you look on the right-hand side also, is that one of the implications of the Brexit vote is it's sort of given a further impetus to this whole trend to sort of QE, lower rates, and certainly we've seen that the Bank of England respond quite aggressively at the beginning of August. But of course that has not helped if you like, it's raised increased concerns around the about the business model of financial institutions. So as you can see here, that the banks I've shown the banks in Italy actually took a very big hit in literally after the Brexit vote. In fact, the Italian FTSE bank index was down over 25%. So, but the point of that is that that's just to highlight that this has got broader implications than just for the UK. If you look at, if we go on to look at what it's meant for fixed income, then you can see clearly, everyone knows that the Bank of England cut the interest rate, the repo rate, down by 0.25% at the beginning of August. I think what's been really very interesting, and having sort of worked in debt capital markets for a long time, it's quite unusual to see sterling fall 10%, economic outlook sort of becoming, more difficult, and at the same time, obviously the lower exchange rate feeds through to potentially higher inflation, but what you've seen is a massive fall in long-term yields. That's, to historic lows. Long-term gilt yields down over 50 basis points since the referendum vote. But I'd also like to highlight, and I'm sure we'll come back to this a bit later, on the right-hand slide here, we'll also show what the long-term real yields have done. And you can see long-term real yields in the gilt market are down to zero. So you've never seen long-term real yields at that sort of level when inflation has been so low. And this actually is a long-term trend that has been, declining real long-term yields. That's been in place for 20 or 30 years. So this is not, as we'll discuss a bit later, this is, this looks, quite structural in nature rather than cyclical. So that's, I think that's a quick overview of where we are from a market perspective.
So Neil, if that's what's going on in the markets, are you seeing, just sticking to the good old Brexit for a second, are you seeing much impact from a corporate perspective at the moment, or?
In terms of the corporate profitability, no, because nothing's really changing, as Paul's alluded to. But it's really the Bank of England's action, and again, I'm not sure Brexit's to blame, because I agree with Paul. I think the structural reduction in long-term yields is a structural one. And in terms of, you've actually got a really good environment for both lenders and borrowers. So from a borrower's perspective, we really want to lock in these long-dated yields. But from a lender's perspective, and clearly those lenders are also managing money, and their liabilities have increased in duration terms as rates have fallen. But they're getting really good credit spreads. I think the credit spreads are still quite attractive. And for example, with rates, with fundamental yields so low, when you add a credit spread, you're sort of doubling your return. You're getting a 100% increase in your return as a consequence of the credit spread. So you're not seeing credit spreads, in my opinion, ridiculously tight. If anything, I think they're quite full.
Yeah.
It's just that and corporates, for accounting reasons, we can't lock in those long-dated yields unless we do it through borrowing. If we just do it through paying fixed in swaps, for example, the mark-to-market on that could be quite profusely hurtful.
Yeah.
And so there is an opportunity, but it's really through borrowing money. So I think the credit spreads are there from a lender's perspective, the underlying yields are there from a borrower's perspective. So you've got a nice meeting of minds, and clearly the Bank of England's there from a purchase perspective, supporting the the underlying issuance activity if it increases.
Yeah, and just going slightly off piece for a minute, which is probably the first of many deviations I'll take. Do you think that QE program that they've announced for purchasing corporate bonds is actually really going to make a material difference to most corporates?
Oh, I mean, just like the ECB has done. I mean, to me, it's a parallel situation. Clearly not large in magnitude, but it's definitely taking supply out of the market, and it's giving a sort of a floor to how, or a cap, if you like, probably more appropriate, to how wide credit spreads could get. And remember, you've still got the ECB there, and in terms of if there's too much dislocation, if sterling yields go up too much from a credit spread, then eventually they're going to attract corporate buyers from the Euroland that then can sort of swap them into euro equivalents. So it's a combination of the Bank of England plus the ECB that is keeping a cap on credit spreads, and also I think, notwithstanding it's a structural issue, but also keeping a cap on underlying interest rates.
But I mean, you're right, Sarah. £10 billion. In relation to the overall size of the asset purchase program, and in terms of the underlying corporate stock that's available, is not big. So it's really a signal effect.
Yes.
And of course, if necessary, the Bank of England has enormous flexibility to increase the program if they so desire at some point in the future.
Interesting. So moving beyond Brexit, Paul, you've mentioned that low interest rates and QE are symptoms of really a more structural long-term issue. Could you go into that a bit more detail, perhaps? Is there are the low interest rates going to be the new normal, or?
Well, I mean, I think this is really a sort of a key question that everyone's debating at the moment, and there's a lot of arguments about as you say, whether low yields are a symptom of underlying structural problems, or are the central banks really stoking up an asset bubble in the bond market? I mean, maybe just to sort of frame this out a little bit, from a theoretical perspective, and I know Neil loves theory. But I mean, yields really, if you break down yields into the various components, obviously, key driver over many years has been inflation, right? So inflation's been falling, so that's feeding into low yields. Risk premium have also fallen because there's been obviously a lot of demand for fixed income product for various reasons. But as I've shown on the earlier slide, I mean, a really key driver here is the reduction in long-term real interest rates. So, and this leads into the whole question of, what is the optimal level? What is the right level of long-term yields, right? So you've got this whole idea of what is the neutral rate. So this is the idea here is that, and this is something that the Fed, as well as the Bank of England and the ECB are grappling with, is what is the right rate that where supply and demand for funds is going to be in equilibrium, such that unemployment and you get price stability and full employment. Okay, so actually, when you start looking at those factors that drive supply and demand for liquidity, you realise quite quickly that these are not factors that the central banks control, right? So we're talking about demographics, the fact that people are getting older and living longer. You're talking about low productivity growth in an age when you've got a lot of technological innovation, but it doesn't really seem to be driving productivity in the workforce. You've also got low investments. What's causing that? Why aren't people investing more? I know we'll come on to that again. You've got rising inequality. Because in this sort of world we live in today, a lot of the wealth is staying with the high net worth individuals who actually typically save more, and many of these savers have an interest in buying safe assets. Now, a lot of this has been driven by capital accounts, the surplus particularly in China and particularly in OPEC. And obviously excess savings in those countries. I mean, just as an idea, we've got to realise that in China, household saving, consumer saving is 40% of their income, right? They don't have access to the sort of welfare and pensions and everything else that we sort of typically expect as a right. And a lot of that cash ultimately is being invested, elsewhere in a global capital market. So the point about this is that, the slow recovery in advanced economies, really, I think it's, there's some real structural issues which very much rhyme with, Summers and, the whole view about secular stagnation.
Yeah.
And I think we think there's quite a lot in that which helps to explain sort of, the current low growth environment we live in at the moment. Obviously, the debt hangover doesn't help, and that's another factor. So basically, all of this is sort of, rather perhaps a long-winded way of saying, lower, flatter yield curves for longer is sort of, is sort of what we're really sort of expecting. Unless, of course, you have a complete, blowout of inflation coming from somewhere, but we just don't see that anytime soon.
Right. Picking up on the point that you make about the lower levels of investment, and maybe coming back to the corporate perspective again, Neil, borrowing to invest seems to be somewhat out of fashion, if I could put it that way at the moment. Do you have a view as to why that may be, whether that's a temporary phenomena or...
Yeah, I think I agree with a lot of Paul said, but since we've seen the end of Bretton Woods and the gold standard, debt has gone up exponentially. It is at ridiculously high levels, and you've actually got a correlation of rates having to fall to support that level of debt. And I think we've got such to have this sort of flatness of the yield curve and zero real returns for 20-30 years is phenomenal, and there is just no one building any inflation consequences at all. And normally we've seen benign inflation, but with always the ability to say, well, in 20 years it will be higher than 30 years. And we haven't seen this time around. We haven't seen this. And yes, there is huge demand for savings, but then the debt's gone up exponentially as well. So I'm not sure that this is a status quo. And I'm not sure this is a stable environment. And so on that basis, I think when you're looking at it from an investment perspective, if you were doing a project for 20 years and you are sat there and doing a net present value calculation for all the ACT listeners who love all this stuff,
some of them.
If you're used to accessing 5-year money, therefore you've got to roll it over effectively 3 times to be able to sit there and justify that using the 5-year rate as your underlying discount rate, whether it be the underlying, whether it be the input to the cost of equity, whatever. Now, rates are so low, where's the confidence that you're about to roll over at those levels? And so that when you do your net present value calculations, you're getting some really good net present valueness, which should encourage investment, but there's this big uncertainty about, can I roll this over for this amount of time?
Do you really believe the numbers?
I really believe the numbers that we're showing. And so on the one hand, I'm not sure whether the central banks, with a zero interest rate policy, and that's obviously impacted the long end, I think, to levels beyond what they thought it would do, I'm not sure whether it's slightly counterproductive. And I think only time will tell. But it is making investment tricky from a sort of a capex perspective, because if it's M&A, the point is the whole environment is there to push up asset values, in my opinion. So if you're buying ready-made assets, I think you've got the environment supportive of it, because effectively assets just keep going up in value, up in value, up. But to sit there and say, I'm confident about the fundamentals, therefore I want to actually start investing in capex, I think that's a slightly different proposition.
Right.
Now, I think, for those of us who are lucky enough to be able to access long-dated money, then clearly we can get rid of that rollover risk in our analysis, and we've got an environment whereby we can sort of invest with the certainty of knowing what our finance is going to be. But clearly, that's got to be someone who's rated, someone who's an investment grade, and it isn't going to be the smaller SME type companies that are going to rely on bank financing. And so, it really doesn't talk to the growth engines of Europe with that small corporate sector. And that small corporate sector should be nervous, because I wouldn't believe that you can keep borrowing money, at sort of 1% levels over 20 years.
Yeah.
And there's another problem in relation to this. Neil spoke about what the economic impact and benefits of capital investment from a corporate perspective are, but actually when we look at it globally, I mean, the key issue is the fact that you could have massive overinvestment in the commodity sector, energy and natural resources, over, obviously not the last 2 years, but prior to that. And those companies have been massive investors in expanding their mines and wells and the like, and of course that's going to take a long time to actually sort of to play out. So they've been cutting back capex massively, which has a depressing impact overall on the regions where they operate.
Right. Before we move, picking up on your point about small corporates and nervousness and their need for the bank market, Paul, is there anything else that you'd like to add from an S&P perspective about corporate borrowing? Have we pretty much covered everything that?
On the banking side.
Yeah.
Well, it's quite interesting actually. I mean, maybe the way we sort of typically think about it is think about supply and demand.
Yeah.
And clearly, on the supply side at the moment, there's clearly no shortage of supply of bank lending to almost all corporates, unless you're in one of the difficult sectors like shipping or where banks have a concentration of risk, or as I mentioned, oil and gas might be another tricky area. So that even actually stretches into the leveraged finance, the sub-investment grade leveraged loan land, where actually conditions seem to be really well in particularly this month have just got red hot. You're seeing enormous demand from investors there. So, but on the demand side, again. Yeah, I mean, a lot of the demand for bank financing seems to be, a lot of the refinancing has been done. So it's sort of, it's basically, just clipping, where you can actually reduce your credit spread and refinance on that basis. It seems to be driving a lot of activity. M&A is the area to watch, because clearly there's an inducement from the central banks and the banks obviously very keen on this as well, because it generates enormous fees to actually to get M&A sort of really started, and there are signs of that happening. I mean, you look at deals like Bayer buying Monsanto for $65 billion, and that's going to be heavily reliant on debt financing. And there seems to be very good willingness of banks to lend on a bridge basis in those types of deals. So yeah, so at the moment, but having said all that, I mean, I think there are discussions to be had about the profitability of banks, and whether Europe particularly is overbanked, what the long term ability to continue to sort of to generate new loans actually are that will meet, help them to meet their return on equity targets, which is still too low.
I mean, I think you would see more significantly jump increase in capex across the whole of Europe. Because I think this is not just a UK phenomenon. No. If banks provided 15 to 20 year money. Now, the point is they're never going to do that, in my opinion. For historical reasons, and likewise, you'd see house prices go up if banks provided 30-year mortgages in Europe, in my opinion, because it's the stability of the financing. But you're not going to see that happening, because I don't think there is a real honest belief in the overall global economic environment being that fulfilling going forward. And there's a huge amount of scepticism, despite the historic low level of interest rates we've got. Because remember, the low level of interest rates are there because the current environment doesn't look that rosy. I mean,
they're a result rather than the cause.
Exactly.
Yeah.
But why would it be banks that would be lending that term? I mean, I don't really see banks in the business providing long-term term loans. It's really much more sort of the institutional investors. The pension funds, insurance companies have.
Because I just don't think they do that with the rating. I mean, I'm hopefully encouraging your industry, but the rating is so important. Particularly with if you're getting unrated assets on your book as a bank now, I don't know what the capital charges are that. You know that better than me, but they're not insignificant. Whereas if you've got a AAA, if you've got a AA corporate or a single A corporate, they're significantly lower. So I don't see we were at the Bank of England forum in November last year. Trying to get money to these to smaller corporates. Yeah, institutional money should be a natural fit, but it's the ticket sizes are so small. The actual cost of investing, the marginal cost of investing, is so high. I don't think it's a solution for the foreseeable future.
No. And do you think that there's a risk that because of all the bank regulation, banks no longer have a clear, well, not only do they no longer have a clear business plan necessarily, but also their cost of funding arguably is higher than some of the corporates that they are supposedly lending to?
I think that's a really good point, because realistically, banks for good investment-grade corporates, their cost of borrowing is higher.
Yeah.
So really, to make a turn on just corporate lending, you really need to sort of migrate down the investment-grade curve, and that's why I think you're seeing, again, talking to Paul's point, the appetite for high yield debt. I mean, we've just done some financing with Liberty in terms of the JV we've got. I mean, it's very, very strong because you're getting coupons of 4 or 5%, and that you can make a return on that as a bank. But you've got something worrying here, is because you're going to migrate the bank's credit, or the credit worthiness of the bank's books is going to migrate to lower levels. And again, I'll ask Paul, but when I look at the causality, or if I look at the flow of bank credit ratings since 2008, it's been on a downward path. It's been, not quite a straight line, but it's very seriously a very strong path. And I sit there and say, fundamentally, is it because banks are reducing the credit worthiness of their books to go and get a return by lending to lesser credit?
Well, I mean, a couple of points there. I mean, first of all, I mean, from the bank point of view, I mean, part of the reason for the deterioration in credit quality of the banks is simply that they're being rated more on a standalone basis. So that, because obviously, too big to fail, and having the sort of, being able to be bailed out by the governments is something that's no longer sort of acceptable.
But with more tier 1 capital, there should be a better credit.
Yeah.
In theory.
Well,
in theory.
Yeah, but that obviously plays into it as well. But at the same time, they have limited capital. So in Europe, it's basically European corporates are too dependent on the banks. In Europe, it's a bit less in the UK, but 80% of corporate funding in Europe is still provided by the banks. So, if you've got a bank market that's capital constrained, it does make sense for the larger investment grade corporates to seek financing through capital markets and other funding routes. So there is a sort of logic to why banks will go down the credit curve in our view. Now, and that can happen in different ways. But it is still the case that they are taking more risk for the returns that they're getting. But that's sort of where the banks should be ultimately anyway, right?
And do you think therefore that banks may not be a fair question, so I apologise in advance if it's not. Do the banks have a bit more appetite, do you think, for that mid-market? Thinking about bank lending.
Well, I think it's. I mean, really, it comes down to what returns they can generate. Can they generate the margins that they need for the cost of capital that they have? Which is why I don't think it's so much a question of availability. It's probably more a question of price. Now, obviously, the discussion was different, 2 or 3 years ago when actually, the banks were really trying to sort of deal with the fallout from the financial crisis, and clearly the smaller corporates, felt that they couldn't get access. I think that's really changed. I mean, but at the same time, the other area that's really come along to help. I mean, we might talk about the private placement market perhaps, but there is quite a thriving direct lending market in Europe, which has sort of developed in the last 2 or 3 years.
Is that like peer-to-peer? Sorry for the own issues.
No. This isn't crowdfunding.
Okay.
This is effectively pools of capital provided by institutional investors, where you've got sort of specialists, typically, bank-trained, lenders, but operating within sort of asset management, fund management type of structure that actually will make loans, to sort of mid-market and sort of smaller companies. But, I mean, this has expanded a lot. You've now got we reckon about 70 alternative lenders in Europe. They provide, upwards of, 15, 20 billion euros of lending a year. Some of the more established names, players like Alcentra or Hayfin, they're now able to do tickets of 100 or 150 million to a single name. So this is sort of interesting because this is helping, to actually, to support and fill the gap that should also help the banks, in their mission to support the smaller corporate.
And you mentioned briefly private placement. There's the BQS PP market. Europe has tried a number of PP approaches. Do either of you feel that there's a need, or would a UK PP market be helpful, particularly in the light of the fact that we're not going to be in Europe for forever, it would appear?
I mean, I've never used the private placement market, so I've not got a view on it as such.
Yeah, I mean, I think obviously, there was a lot of discussion about trying to sort of create a pan-European private placement market as part of this sort of capital market union project, which obviously is sort of a little bit, the future of that is a little bit clouded, even though actually it's still, I think, as we've already sort of implied, is a very important, development for Europe to help to reduce the dependency or over-reliance of corporates on the banks. But the problem with the European private placement market is it's so segmented by country. So you've got the Schuldschein market in Germany, which is really bank and Landesbank, sort of two-thirds of the funding is provided by them. And in France, you've got a Euro PP market, which is sort of fairly new, where it's basically asset managers and insurers. UK companies, corporates typically, they have a well-trodden track to the US private placement market, which sort of seems to work quite well. So it's very difficult to see how at the moment you're going to get some sort of impetus for a PP market, even in the UK. And as I say, I think actually people are probably looking the wrong way, because this direct lending market is sort of actually really, it's addressing the issue, because it's hitting that mid-market, which wouldn't naturally have access to the private placement market because it's high grade, right? So in fact, I think the direct lending market really is sort of is playing an important role.
I think just first principle thinking in the UK, I think the institutional investors like liquidity, and the private placement market doesn't lend itself to liquidity. No. And and they particularly like liquidity when it's long-dated money. So I think that you've got sort of some, if you like, historical or sort of some hygiene factors from a UK investor perspective that don't necessarily sit well to support a significant or a material private placement market.
Talking of liquidity, that would take us naturally into capital markets and the bond market. From your perspective now, how's that market been changing? Is it getting a little bit longer dated, or what about the impact of regulation through that market? Are you seeing any changes? Because I'm guessing that you're still fairly active in.
So we've been very active this year. You've still got the tendency for the European market to be concentrated for maturities up to 10 years. I mean, 15 years is effectively the equivalent of 30 years in dollars and sterling. But you're seeing very deep liquid markets again with the ECB there in terms of accessing capacity up to 10 years. And there's been a huge amount of issues this year as everyone's pre-funded, I think, maturities for a number of months to come, maybe years to come. The sterling market clearly was very active post the Brexit and then the actions by the Bank of England. As I said, realistically, the move in yields has caused them a problem in terms of all of the. I mean, if you've got a negative interest rate, the duration of your bond and likewise duration of a liability is now longer than its life, which is a real weird concept, isn't it? I mean,
Yes. That's hard math.
It just doesn't sit right. But that's the sort of, the move down has meant that there's been a demand for duration. And so I think you've seen effectively a few corporates, including ourselves, access that demand as a way of locking in a longer rate. As I said, I don't think credit spreads are particularly attractive from a borrower's perspective, but the overall rate is attractive. But Europe is very deep for maturities up to 10 years. and it continues to be. And clearly, with ECB buying 80 billion a month, that's a big support package to mean that there's good access to that European market.
Thanks for that. Can we just, I'm aware that time is ticking, can we just briefly turn to the role of credit ratings in funding decisions? Paul, what do you feel that these macroeconomic conditions mean for credit prospects generally over the next couple of years?
Okay, so I suppose we can look at it in various different ways. Obviously there's a sector aspect to it. There's a short-term, long-term sort of perspective here. I think the short term, in the UK, I guess, until Article 50 is sort of, until the exit from the EU becomes clearer. Clearly it's sort of as much as possible business as usual. Given what's happening in financial markets, multinationals, exports, companies dependent on tourism inbound are better protected, but more domestic industries, likely to sort of experience some headwinds. Also, consumers, don't forget, we're going to see imported inflation. We are seeing imported inflation picking up. So, and oil prices obviously are picking up a little bit as well. So that feeds through to some upward pressure on inflation, which is obviously what these central banks would like to see, but actually does have the effect of sort of weighing down a little bit on real disposable income for corporates.
So do we think that seeing an uptick in inflation would be one of the leading indicators for the next downturn? Or are we still in the downturn?
I think
what things do we need to watch to worry?
I think you really need to differentiate between actual inflation and expected inflation, right? Yeah. An uptick in actual inflation, if it doesn't feed through to expected inflation or inflation expectations, and I think I could say they're one of the same thing, you're going to get no movement in curves. The curves are still going to remain flat. What we need to engineer, really, to get rid of this debt pile, the central banks need to engineer a massive increase in expected inflation that actually comes through. So you need to see a massive increase in actual inflation that isn't expected. So effectively, it really removes the value of debt. I think it's a really tricky thing to achieve. And until that, I think you've got rates at this low level. I think irrespective of, we are due a credit cycle. It's been the longest credit cycle we've had for, I don't know, ever maybe. But certainly out there.
Yeah.
I can't see it changing, because underlying rates are going to be so low for so long.
Yeah, but it's not just inflation. What's important is nominal GDP, right? So it's a combination of real GDP plus inflation to actually sort of. So it's growth, a combination of growth and inflation that's critical. And I would certainly support Neil in what he was saying. This is not a normal business cycle. This has been much more, as much driven by the sort of financial cycle that we're in, and so that there are much bigger structural forces at play. So seeing a tick up to inflation, on the back of stabilisation of oil prices and a fall of sterling is, that's sort of background noise, to a large extent.
And would we also classify things like the recent uncertainties around some banks, the amount of credit in China, to be diplomatic, things like that? Are we going to start seeing a repeat of the Lehman cycle, if I can put it like that, or do we think that it's just sort of more noise in the machine at the moment?
Well, I think there are clearly factors and risks that we track carefully. Thinking about what the downside risks are, and you allude to China. The amount of the corporate debt in China is massive, and much of that is held with the state-owned enterprises. So, that's a real issue to watch. But we're also looking at the other sort of risks we watch, which aren't embedded in our ratings. Are the whole sort of geopolitical risk in Europe. This whole refugee crisis, Syria, terrorism. These are all sort of real credit developments to watch. Politics. In Europe, with the elections in France and Germany, and the need to get reform in Europe, to actually, to sort of really solidify the institutional architecture of Europe is really, really important. And also the last thing that we think plays into corporate credit is very much this whole issue of, overinvestment. A lot of it's China facing in terms of, the supply chain to China around commodities and shipping, and essentially the overinvestment in some of these heavy industries. So that's really, that's the sort of cloud hanging over us for quite a long time.
So Neil, final question. Is there any good news at all out there when we're thinking about funding?
Rates are going to be low for a long time. I think that's good news. As I said, I don't think credit spreads are particularly cheap. But the one thing, the negativity that I think, if you're going to have negativity, no one really knows how we get rid of QE and how we get rid of this massive central bank support. And I think, trying to exit from that. And I don't think I think the good news is I don't think you're going to exit from that for a hell of a long time to come. I think that's going to be the trauma. Because I think, you're going to be walking on eggshells trying to exit from that. And you could easily go, plop and get it completely wrong. And that's what scares me. But whilst the central bank, I can't believe that the confidence in the central banks is as robust as it clearly is. But people say don't fight the Fed. I think you can extend that to don't fight central banks. They're there.
But I mean, monetary policy is, has done all it can really to support the economy in Europe, and obviously Japan. So we need government spending. We need reform. There's a lot of other things that need to happen to actually sort of help to try and address the issues, the problems that have been created by this sort of this extraordinary monetary stimulus that we've seen.
All right, and on that very cheerful note, thank you very much, gentlemen. Time's come to wrap up. So I'd like to thank you both, Paul and Neil, and to S&P for their sponsorship. Secondly, I'd like to thank everybody who's dialed in today. Hope you found it interesting and thought-provoking conversation. I'm sorry if we didn't get to your question. We will respond to some of these questions directly following the webinar. As I mentioned at the start, we will be putting up a recording of the webinar on the ACT website, along with the presentation in a couple of days, and we'll send you all a link to that. Finally, if you could spare a moment to provide some feedback, there's a survey widget on the bottom bar, which would be very helpful if you could do that. That would be great. Finally, there are a number of upcoming events, and in particular, I look forward to seeing as many of you as possible at the annual dinner, because that's always jolly. And also, on a more serious note, there's a technical risk forum, which is clearly a very current agenda at the moment, and that's next week. So do register if technical risk is something that worries you. Finally, from all of us here, thank you very much.